the idea behind these vaults was that gold would be able to flow in and out as a counterpart to Chinese yuan and short-term instruments. So in other words, what they were doing is they were setting up a prospective modern version, if you like, of Bretton Woods Mark II. The amount of gold in China is absolutely enormous. And so even though China has quite a lot of government debt, mainly in the form of local governments, she can easily go onto a gold standard. And I think that's that is the ultimate protection from a dollar collapse.
As global financial markets contend with mounting sovereign debt and persistent questions about the sustainability of fiat currencies, the potential for significant systemic shifts is rising. The prospect of a gold revaluation, or a disclosure of substantially larger Chinese gold reserves than officially reported, could have profound and immediate implications for asset prices, capital flows, and monetary policy frameworks. Moneyweek, after a long study, reported some years ago that undocumented imports through Hong Kong, clandestine central bank buying, and their own internal mining would put the figure well above 20,000 tons. Some economists claim this figure to be conservative. In the wake of escalating U.S. tariffs, China made a move. Celebrated economist and stockbroker Alasdair MacLeod says Beijing has quietly built massive gold reserves, effectively turning the country into Hotel California for gold. He emphasizes that China is now positioning the yuan as a gold-backed trade settlement currency, creating a Bretton Woods II system. Today, that price is just below $3,400, an almost 8,000% increase. For the astute, however, this isn't gold becoming more expensive per se. It is a catastrophic loss in the purchasing power of the fiat currency that buys it. Even billionaire hedge fund CEO Ray Dalio of Bridgewater Associates has recently discussed the revaluation of gold and offered advice to allocate 15% of your portfolio. A far cry from the 60-40 stocks and bonds of the last 40-year bull market that is now well and truly over. Some very big players are talking. While the Fed could fuel a final market melt-up by cutting rates, Alasdair MacLeod warns that stocks are dangerously overvalued. He predicts that rising treasury yields or a weakening dollar will trigger a renewed bear market. The real play is in mining stocks, which have yet to benefit from the BRICS' new industrial revolution. Before we dive into Alasdair MacLeod's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, first of all, as to whether there's a melt-up, we've had something of a melt-up. We don't know, until it happens, whether the melt-up has got more to go. It is not unusual for the Fed to be cutting interest rates at the wrong moment in the cycle, if you like, in the credit cycle, and give the stock market an extra impetus upwards. So I don't rule that out. I just say that anyone sitting on, stocks and all the rest of it should realize that they are incredibly overvalued. I think the thing that will tip it would be a rise in, the two things that can do it, a rise in the yield on the 10-year and also longer maturities, treasury maturities. The 30-year is basically ready to break out on the upside. And when it goes through 5.1%, something like that, then hold on to your horses. That's going to be, the bear market resuming in style. I think the second thing is we look at the dollar. The dollar's trade weighted is knocking into, lower ground the whole time. And if it breaks the current level, which is, roughly 97, 96.8, something like that, if it breaks that, then the chart tells us that it is going down and down and down. So these forces are just waiting, I think, to trip up markets. Your comment about mines, I think, is interesting. We haven't had the great rotation out of industrial equities and maybe tech stocks into the mining sector yet. Mines so far have, rather like gold, reflected the prospects, if you like, for what's happening, rather than being driven by actual, investor asset reallocation. And I think the good thing about mines, I wouldn't restrict this just to precious metals, but also base metals, is that I have no doubt that China's plans for the SCO and BRICS, really what we're talking about is a new industrial revolution for the underdeveloped world. This is going to have an enormous impact on demand for commodities and so on and so forth. And at the same time, if you can see a fall in the purchasing power of fiat currencies, then you can, without too much stretch of imagination, see both base metals and precious metals going far higher. And that's obviously very good for miners' margins, so long as their costs don't rise at the same pace, which I don't think they will. And as I say, the underlying situation is that we have yet to see, if you like, flows, investment flows, really going into the sector. That is ahead of us. So I think I can imagine enormous gains in reasonable mining prospects. What's really emerged in recent months, and this was particularly since April the 2nd, when President Trump stood up and said all these tariffs, and China was, I think at that stage, it was 64% or something. And, then that was raised to 140%. Yeah, I mean, this capricious approach, basically what it did was it triggered for the first time China actually taking the initiative on economic and monetary matters. The first thing that President Xi did was he went round and visited, he didn't visit actually, but what he did was the Chinese authorities reaffirmed their desire to form a free trade area with Japan and South Korea. Those plans were being accelerated. And in the week following, President Xi did a whistle-stop tour of the ASEAN nations, surrounding and to the south of China, talking to, obviously, senior politicians at presidential or managerial level, as it were. And so there was something obviously being cooked up. This was rapidly followed by an announcement from the Shanghai Gold Exchange, which again was prompted by the People's Bank, again prompted by President Xi, that they would open vaults in Hong Kong, and that's already done, as I understand it, and also in Saudi Arabia, with other gold trading centers in ASEAN nations to follow. And the idea behind these vaults was that gold would be able to flow in and out as a counterpart to Chinese yuan and short-term instruments. So in other words, what they were doing is they were setting up a prospective modern version, if you like, of Bretton Woods Mark II, whereby governments could, if you like, settle their trade differences in effectively what works out as gold-backed yuan. And interestingly, I mean, China had cornered the gold market, the global gold market. I know it's not reflected in the People's Bank's reserves, but I know certainly on through deduction, and also confirmed by people who have actually seen this in China, that China has accumulated huge gold reserves secretly and posted them around various accounts like the army, the youth wing of the Communist Party, and so on and so forth. I mean, really, China has been Hotel California for gold, really, ever since the late 1980s. Anything that goes in there doesn't come out. The amount of gold in China is absolutely enormous. And so even though China has quite a lot of government debt, mainly in the form of local governments, she can easily go onto a gold standard. And I think that's that is the ultimate protection from a dollar collapse. I mean, these Chinese are not stupid. They understand the consequences of trying to move away from the dollar for what amounts to 70% of the world's population, or governments controlling 70% of the world's population. And that is something that's really just beginning to emerge. And so we can see where the future is going to go. Well, we go to hell in a handcart, with our currencies. China is already on the way to protecting its currency from the same fate. And interestingly, it's not so long ago that all the official noise coming out of Shanghai Cooperation Organization and BRICS meetings is that members will be using their own currencies to settle trade differences. That's gone now. You don't hear that anymore. It's going to be the yuan. The yuan is, if you like, the new gold-backed international currency. That is the role in which the Chinese are carving out for themselves. Very important to understand that, I think. That's a big, big development. And so far, I see very, very little reporting on it.
In his analysis, Alasdair MacLeod voices that it is misleading to call inflation simply a rise in prices. Instead, it reflects a fall in a currency's purchasing power. He warns that the world is sitting on a historic credit bubble in U.S. equities and treasuries. If markets turn, massive foreign selling could crush the dollar and send a shockwave through the global economy. The Federal Reserve has multiple tools to stabilize markets in the short term, including providing time-limited liquidity, activating dollar swap lines, supporting non-bank cash conduits, and lending to non-banks. These actions buy time, but are not sufficient by themselves to restore long-term confidence. The U.S. is trapped. MacLeod notes Washington is caught in a debt spiral, with a shrinking tax base unable to cover its rising costs. He warns that roughly $130 trillion in dollar assets held overseas are footloose capital waiting to flee. This is why central banks aren't just buying gold, they're exiting dollars and euros in a desperate flight to safety. For MacLeod, the dollar's collapse is inevitable without a radical political reversal. Let's get back to the interview.
To call a fall in the purchasing power of a fiat currency inflation actually is a misnomer. There are two ways in which a currency can depreciate. The first is the obvious one, which the monetarists will tell you, and that is that if you increase the amount of the currency or the amount of credit in the currency, you will debase its value. That is undoubtedly true and holds for what we might call normal times. But there is another factor, and that is faith in it, because there is absolutely no anchor at all to the value of a currency other than its users' faith in it. Now, if the users of a currency suddenly sort of question its value, then that can have a very, very violent effect. I think what we're seeing is the build-up of violent effects. We've got a huge, great overhang of dollars in foreign hands, which are being held unnecessarily. And not only that, but in recent months, China has begun to formulate the way forward for its currency being, if you like, the equivalent of the dollar, the reserve currency for the entire Shanghai Cooperation Organization and BRICS. Now, that does mean that the rest of the world has got surplus dollars. The only other reason that they've got dollars, basically, is they're speculating in U.S. equities. And according to the U.S. Treasury's tick figures, foreign investment in U.S. equities is in the order of $15.5–16 trillion. I mean, that is huge. Now, that's all fine and dandy when things are going well. But as soon as they start turning down, those dollars get sold. Now, we are in a debt-cum-credit bubble, and it is the largest bubble in history ever recorded. We have exactly the same conditions that we had, but more violently so, in 1929 and 32, when you had a combination of the roaring 20s debt bubble, debt-cum-credit bubble, and at the same time, Smoot-Hawley tariff acts being brought in by President Hoover. Today, we've got exactly the same condition, but it is far larger. And sooner or later, that bubble's going to burst. And I don't know that it'll stop at a 90% loss for the S&P, which is what happened in 1929, between 1929 and 1932. That we've yet to see. But there is no doubt that there will be massive foreign selling or attempted selling to try and avoid those losses. And at the same time, they're invested in US Treasuries. And guess what? The US Treasury is in a debt trap. That is going to become even more apparent as the economy slides into recession, because the tax base that in theory covers the financing cost of the debt is diminishing. Classic debt trap. So you've got increasing risk as far as holders of dollars are concerned. So what do they want? They want higher protection. That basically means higher yields along the yield curve. And it's not just America in this crisis. When it comes to the debt crisis, virtually all the G7 are in debt crises of their own. And it's really a race as to which one gets into trouble first. And I think the dollar is the most important one. So I tend to focus on that. Now, we can see that there are gathering forces driving the dollar down. Now, when the dollar goes down, what that means is its purchasing power falls. And as that purchasing power falls, it will be reflected in higher prices. That is the fundamental problem. The Fed is ignoring it by cutting rates. There's no doubt that a quarter-point cut was politically motivated and was a compromise. I understand that Stephen Mirren was the only FOMC appointee who voted for a 0.5% cut, which doesn't surprise me at all. But you can see that the political pressures on the Fed make it impossible for them to keep an eye on the dollar. Not only that, but Mirren and also President Trump have said they want to see a lower dollar, lower interest rates, etc. They are winning that argument. And it is a surprise to me, really, that this hasn't been, if you like, understood by markets, and particularly foreign holders of dollars. But they will sell, and they will sell huge quantities of that. There is no doubt. As I say, you've got these two basic reasons. You've got the problems within America, which are driving the dollar's purchasing power down. And you've also got all these footloose dollars held by foreign governments who are moving away from the dollar. And if you want confirmation as to exactly what central banks think, they say they're buying gold, but actually that's the wrong way to look at it. They're getting the hell out of dollars and euros, I guess, as well. So what do you go into if you get out of fiat currencies? Well, the answer is real, legal money without counterparty risk, which is gold. And that basically is the situation today. You've got $40 trillion of financial assets and deposits. In other words, that's the bit that's recorded by the US Treasury. But because of the way in which foreign exchange markets work, if you sell one foreign currency into another, which is not the dollar, basically you sell currency A to buy dollars, and then you sell dollars to buy currency B. The result is there is a floating mass of dollars, which the Bank of International Settlements estimated to be in excess of $80 trillion. And then on top of that, you've got the euro-dollar market, which is an offshore market not recorded in any figures of the US Treasury, and that's a further 10 billion. Add them all up, and you've got 130 trillion. Sorry, these are all trillion, these numbers. You've got 130 trillion in foreign hands, which, as you're highlighting here, is over 4 times the size of the US economy. So, there is little doubt in my mind that the potential is there to absolutely crush the dollar. And, where does it stop? I mean, the only way it stops is if the authorities have the political mandate to stop it. And they don't. I mean, for a start, the politicians in the form of Trump et al. Are spendthrifts. So they would have to do a complete volte-face. And secondly, they're elected by electors who have always got their hands out for subsidies or support of one sort or another, and all the lobbying interests and so on. Washington is built on that, just the same as Whitehall is built on that. So this is this really is something which will require a huge, great reversal.
The system has always been designed to privatize gains and socialize losses, and Main Street will always fall victim to this. The higher the valuation of gold, the worse the socio-demographic problem will be. However, countries such as China, Russia, and Iran have increased their non-dollar trade, and central banks have raised their gold holdings and diversified their foreign exchange reserves. If China openly declares its true gold reserves or revalues the yuan against gold, will this mark the final tipping point for the US dollar's role as the world's reserve currency? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.